In Chapter 7, we are looking at cash and receivables. So we are going to be looking at a numerous amount of exercises related to these two areas. Started. In exercise 7.1, the controller of White Herring Corp is in the process of preparing the company's Year 1 financial statements. She is trying to determine the correct balance of cash and cash equivalents to be reported as a current asset in the balance sheet. The following items are being considered. Balances in the company's accounts at First National Bank checking $10,500, savings $21,600. Undeposited customer checks of $5,200. Currency and coins on hand of $570. Savings account at the East Bay Bank with a balance of $390,000. This account is being used to accumulate cash for future plant expansion in year 3. $40,000 in a checking account at East Bay Bank. The balance in the account represents a 20% compensating balance for a $200,000 loan with the bank. So it represents money they have to keep on hand because of a loan. White Herring may not withdraw the funds until the loan is due in year 4. U.S. Treasury bills, 2-month maturity bills totaling $11,000 and 7-month bills totaling $20,000. So basically we want to see what are included and what are not. So of these items, included in the cash and cash equivalents, the balance in the checking account of $10,500 and savings account definitely are part of cash and cash equivalents. Undeposited customer checks, they are part of cash and cash equivalents. The currency and coins on hand, yes, those are too. The U.S. Treasury bill with a 2-month maturity of $11,000 is. But that's all. The savings account is considered an investment. It's an investment in the long-term category because it is money restricted or set aside to accumulate for a future plant expansion on something that will be happening in 2 years from now. The restricted cash is not part of your normal cash balance because you must keep that $40,000 on hand at all time. And that 7-month bill is not considered a cash equivalent. It is considered an investment, a short-term investment. Okay, so your total cash and cash equivalent of those items, $48,870. In exercise 7.5, Lamsey Corporation, a manufacturer of electric equipment, sold 100 units to Radius Company on January 17th. The units have a list price of $200 each, but Radius was given a 10% trade discount. Terms of the sale were $210 net 30. So now we're getting into the accounts receivables. What we want to do is prepare the journal entries to record the sale on January 17th, ignore cost of goods sold, and then the collection on January 26th, assuming the gross method is used to record the cash discount. We'll talk about 2 and 3 in a second. So before we get into the answer, first of all, when in this circumstance, this company is offering 2 distinct discounts. The first being a trade discount. So it's saying before we even book the sale, we're going to give you 10% off what we normally charge people. It's more of a volume discount. Those discounts are not recorded in our accounting records. It's like the sale was made at 90% of the list price. The credit terms offer a different type of discount, a cash discount. And that is, if you pay us within 10 days in this case, take a 2% discount customer. Cash discounts are recorded in our accounting records. So let's see how this all works out under both methods. Lamsey Company, again, sold 100 units on January 17th. The list price is $200. So normally $200 times 100 units, $20,000. But Radius, the customer, was given a 10% trade discount. So the sale price will be $18,000. Lampsey will debit accounts receivable under the gross method $18,000, credit sales revenue $18,000. Now on the 26th, when Lampsey receives their payment and they receive it within 10 days, the customer is going to take a discount. Cash will be debited for $17,640. How do we get that? Well, the customer is taking a 2% of $18,000 discount, or $360. So, a sales discount, a contra revenue account, will be debited $360. And then accounts receivable is credited for the entire amount. So that is how a company will handle a accounts receivable sale with discounts under the gross method. What happens if Lampsey uses the net method? In the second part, Lampsey sells again the 100 units, $200 each to Radius, giving them a trade discount. What happens under the gross method if the sale is recorded on January 17th, debit accounts receivable, credit sales revenue? Just like before. What's different with number 2 is Radius isn't paying the bill until February 15th, well outside of the cash discount time. So just to demonstrate what would happen, we would debit cash for $18,000 and credit accounts receivable. They just don't take the discount. In the next method, though, Lampsey records the sale as under the net method, I should say. In this case, Lampsey assumes the customer will take the discount when they're recording the actual sale. So that means they will debit accounts receivable for $17,640. They'll subtract out the $360 as well and credit sales revenue for that dollar amount. Now, if Radius pays within the discount time, our assumption was right at Lampsey. Debit cash for the $17,640, credit accounts receivable, $17,640. But what if Lampsey pays the bill in February? Still record accounts receivable and sales revenue the same way on January 17th. But in February, Lampsey's going to receive $18,000 because Radius did not take advantage of the discount. Credit accounts receivable for the $17,640 because that's how much you originally recorded. And then credit a revenue account called sales discount forfeited for the $360. And that's usually listed in the other income and expense section of your income statement. So just demonstrating you 2 ways to record accounts receivables. What a trade discount is, how it impacts your journal entry, what a cash discount is. Exercise 7-8. Delphax Manufacturing allows its customers to return merchandise for any reason for up to 90 days after delivery and receive a credit to their account. All of Delphax's sales are for credit, no cash at time of sale. The company began year 1 with an allowance for sales returns of $200,000. During the year, Delphax sold merchandise on account for $12 million. This merchandise cost Delphax $8,400,000, or 70% of their selling prices. Also during the year, customers returned $400,000 in sales for credit. So this company actually estimates its sales returns at the end of each year when the sales are made and records them as a decrease to sales revenue now, and actually they have to. What we need to do is prepare the entry to record the merchandise returns and the year-end adjusting entry for the estimated returns. And what is the amount of the year-end allowance for sales returns after the adjusting entry is recorded? So, the first significant journal entry will be recorded on December 31st for the actual returns made during the year. Sales returns debited for $400,000, accounts receivable credited for $400,000. Inventory is debited for $280,000 or 70% of the selling price. Cost of goods sold is credited for $280,000. At the end of the year, the company estimates their returns will be $600,000, 5% of the $12 million in sales for the year. Additional sales returns to be recorded will be $200,000. They estimate $600,000 will be returned. $400,000 were recorded as returns. So the additional amount that still have yet to be returned will be debited to sales returns and credited to the allowance for sales returns account. Inventory estimated to be returned, asset account. Inventory estimated for returns will be debited. That's the estimate of the cost of the inventory that will come back yet. $200,000 times 70%, and cost of goods sold is credited for the remaining amount. Now, what is the year-end allowance for sales returns after the adjusting entry is recorded? It started with a balance of $200,000. It had a year-end estimate of $600,000, but $400,000 were actually returned. Ending balance in the allowance account, $400,000. Exercise 711. Penny Cookie Company offers credit terms to its customers. At the end of year one, accounts receivable totaled $120,000. The allowance method is used to account for uncollectible accounts. So that means they estimate for bad debt expense each year. We just have to see which method they use to estimate. The allowance for uncollectible accounts, which is a contra account to accounts receivable, has a credit balance of $12,000 at the beginning of year one. $6,200 of accounts receivables were actually written off during the year as uncollectible. $600 in cash was received in December from a customer whose account was previously written off. And the customer estimates bad debt expense each year by applying 6% to accounts receivables at the end of the year. So we want to prepare the journal entries to record the write-off of receivables, the collection of $600, and the year-end adjusting entry for bad debt expense. And then how would we show accounts receivable in year one's year-end balance sheet? So let's take a look. First of all, to write off receivables under the allowance method, so this is an actual bad account, we decrease the contra allowance for uncollectible accounts, the contra account to accounts receivable, and credit accounts receivable. So we're doing nothing with bad debt expense when there's an actual write-off. Bad debt expense is only affected during estimating. What happens when an account written off previously is collected? It's a two-step process. The first step is you reinstate the accounts receivable. Debit accounts receivable, credit the allowance for uncollectible accounts. You want to put that dollar amount back into that account. So you're essentially reversing the write-off of that $600. You then want to collect the cash and credit the accounts receivable. So when you collect on an account that was previously written off, reverse the write-off, then show the cash coming in. Do not try to take a shortcut. Now, at the end of the year, the beginning balance of allowance for uncollectible accounts is $12,000. They tell us that in the credit column. The allowance account is a contra asset, so the increasing side is the credit side. They wrote off or decreased this account $6,200. So the credit side always represents the estimate of what you expect to write off. The debit side represents the amount you actually wrote off. We put $600 back on the credit side of the allowance for uncollectible accounts. So as of right now, there's a credit balance in the allowance for uncollectible accounts. When you're estimating for uncollectible accounts at the end of the year and you use accounts receivables to estimate, you are really determining what the new balance should be in the allowance for uncollectible accounts. So 6% of 120,000. You want the credit balance, I don't know why that's in brackets, I don't like that. You want the credit balance in that account to be $7,200. Currently, it's at $6,400. So the difference, $800, is how much your journal entry will be. Watch the journal entry. Debit bad debt expense, $800. Credit the allowance for uncollectible accounts. So when you use accounts receivables to estimate uncollectible accounts, you're really determining how much the new balance, the balance must be in the allowance account at the end of the year. So that's your focus. So you're going to credit that account, or you may need to debit it to get it to that balance. You do the opposite to bad debt expense. Your focus in this method is not on bad debt expense. How will accounts receivables be shown? Well, the current balance in accounts receivable is $120,000. We'll subtract the new balance in the allowance for uncollectible accounts. So the reality balance, the net realizable value, $112,800. Now I just want to bring to your attention, $120,000 is what is owed to the company, and the company does everything in their power to collect that money. But we live in a reality. The company knows based on their past experience, they're probably not going to collect some of that. And according to their best estimate, $7,200 is how much they think they won't collect. So according to conservatism, if we know we're not going to get a certain amount in an asset like this, report the reality, $112,800. Exercise 714. Now we're going to switch gears and start looking at notes. On June 30th of year one, the Sapphire Company sold some merchandise to a customer for $40,000. In payment, Sapphire agreed to accept a 6% note requiring the payment of interest and principal on March 31st, year two. The 6% rate is appropriate in this situation. Pretty straightforward here. The first thing we're going to do is record the sale of the merchandise using a note. We're going to omit cost of goods sold. We're then going to do any interest accrual at the end of the year, and then the ultimate collection on March 31st of year two. So, Sapphire's who we're focused on here. On year one, June 30th, Sapphire will debit notes receivable for $40,000, credit sales revenue $40,000. And the reason they do that is because they're charging principal and interest on the payment, and the 6% is a realistic interest rate. On December 31st, though, they've earned a portion of this interest for the year, 6 months of it. So they're going to debit interest receivable for $1,200, credit interest revenue. How did we get the $1,200? The $40,000 principal times the 6% interest rate, which is always an annual interest rate. We don't want to know 1 year's worth of interest. We want to know 6 of 12 months of interest, $1,200. We record interest when it's earned, not when we necessarily receive it in cash. So at the end of December of year one, there's $1,200 of interest revenue missing. Get it recorded. We're not getting the cash on December 31st, so it's owed to us. Debit interest receivable. Now on March 31st, the company is going to receive cash. How much? Well, $40,000, which is what is owed, plus the interest on this loan. $40,000 times 6% times 9/12, because this is only a 9-month loan. $1,800. Of that $41,800, they will credit note receivable for the principal, $40,000. Got to reduce that account to zero now. They'll credit interest receivable for the $1,200 of interest that's already been recognized as revenue. They're receiving it now in cash. The remaining $600 of interest is interest revenue for the first 3 months of the year. So 3/12 of the interest was earned in year two, recorded as interest revenue. Okay, sweetie, I'm doing a voice. If the December 31st adjusting entry for the interest accrual is not prepared, by how much will income be over or understated in year one and year two? Well, in year one, it will be understated by $1,200. You'd be missing $1,200 of revenue. And if you waited till year two to report it, then you would be overstating year two by $1,200. So that's why it's very important we record interest revenue in the year it's earned. Exercise 717. On January 1, year one, the sole company exchanged some common stock it had been holding as an investment for a note receivable. The note principal plus interest is due on January 1 of year two. The year one income statement reported $6,000 in interest revenue from this note and a $10,000 gain on the sale of investment in stock. The stock's book value was $20,000. The company's fiscal year ends on December 31st. So now it wants us to reconstruct the journal entries and try to figure out what's the note's effective interest rate. Interest reported for the year, the $6,000, divided by the value of the note, will give us the note's effective interest rate. Well, they don't tell us how much the note is for, but you can do that. If you take the stock's book value, $20,000, and add the gain, that's the selling price of, or that's, well, no, actually, that's the, it doesn't matter. You know the amount of the note. It's $20,000. Okay? So, the carrying value of the stock is $20,000 plus the gain. Hold on a second. Yeah, okay, I'm doing it wrong. Yes. So the selling price of the stock is $30,000, which would be the book value of the stock plus the $10,000 gain. So they sold the stock for $30,000. Sorry, I got backwards a little bit in my head. So the value of the note is $30,000. The interest reported for the year is $6,000. $6,000 divided by $30,000 gives you an effective interest rate. Wow, of 20% for the year. That's a lot. Let's reconstruct the journal entries. On January 1, when the company exchanged the stock, note receivable was debited $30,000, investment credited $20,000, what they had originally bought it for, and then gain on sale of investment is credited for $10,000. On December 31st, the company would have debited interest receivable and credited interest revenue for the $6,000. $30,000 times 20% for the entire year. So that's why there's no time factor. So those would have been the journal entries for the year. Exercise 718. June 30th, year 1, Apaka Shoes had outstanding accounts receivable of $500,000. On July 1, year 1, the company borrowed $350,000 from the ex-finance company and signed a promissory note. Interest at 11% is paid monthly. The company assigned specific receivables totaling $500,000 as collateral for the loan. There's a financing fee of 2% assessed on this assignment of accounts receivables. What is the journal entry to record the borrowing on the books of Apaka? Well, it says nothing about the financing company taking over the accounts receivables themselves. So all that's happening here is Apaka borrowed money, said we'll still collect on the accounts receivables. We're just going to use them as collateral. So right off the bat, before they get their money on the note, $10,000 is subtracted from it for the financing fee. For finance charge expense, $10,000. Liability on the financing arrangement is $350,000. That's how much they borrowed. And if you're saying, well, they put $500 as collateral, yep, and that's how it goes. Okay, so they're not giving them $500,000 in receivables. They're just saying that's what we're going to use as collateral. And ex-finance says, yep, that's what you have to do. So if you default, we're taking those, even though you're only borrowing $350,000. So their cash is $340,000. They owe $350,000. Let's take a look at this one. Delta Ice Cream transferred now $61,800 of accounts receivable to the Prudential Bank. The transfer was made without recourse. So this is a sale, but it's made without recourse. Highlight that. Prudential remits 86% of the accounts receivable factored to Delta and retains 14%. When the bank collects the receivables, it will remit to Delta the retained amount, which Delta estimates has a fair value of $3,000, less a 3% fee of the total factored amount. So this now is an outright sale. Delta will no longer own their accounts receivables. They are going to receive cash. Prudential Bank is taking these accounts receivables and now will be responsible for collecting them. Because of that, there's other items involved here that we need to account for because of the risk of default by these accounts receivables. So Prudential isn't going to give them all their money. They may give some of it later if they collect all the money, but they have to protect themselves up front. So what will Delta do when they sell these? And remember, it's without recourse. So this means that if Prudential does not collect all the money, they can't come back at Delta. It's their loss. So first of all, Delta Ice Cream will credit accounts receivable for the full amount. They no longer own them. Prudential now owns them. But they're only going to debit cash for 86% of their value. So they gave up quite a bit of money there, a couple $1,000s, to get their cash quick. So they have all these accounts receivables. They're waiting to collect on them. If they need cash now, this may be their only alternative. Sell them. Receivable from factor is determined. Let me show you that. I think that's the 3%. Grab my calculator here. Should have had that done. 61.8. Nope, that's not it. Let me see this a second. Oh, less the 3% fee. Okay. That's what's going on. Okay, so if Prudential collects all of the accounts receivables, they will send some money back. Delta thinks that there might be about $3,000 coming back to them. But Prudential says, yeah, we're going to still charge you 3% off that $3,000, which is $1,854. So if you take 3,000 minus 1,854, you're not going to get 3,000 back from us. You're only going to get $1,146. And then the difference is the actual loss on the sale. So what this is saying is they gave up $61,800 in accounts receivables. They got cash immediately of $53,148. If Prudential collects all the accounts receivables, the most they can get back is $1,146. That's all they're getting out of this. So the receivable minus the cash and the amount they may get back in the future will be subtracted, and you have an ultimate loss on sale of receivables, $7,506. Now, it may be in Delta's best interest to do that because they need the cash now. Exercise 720. Delta transfers $61,800 of accounts receivable. The transfer is now made with recourse, meaning Delta's still in the mix. Prudential will not take the hit if they can't collect on an accounts receivable. They could come back at Delta for the money if a customer defaults. Prudential remits 90% of the factor amount to Delta High and retains 10% to cover sales returns and allowances. So you have to remember that when there's accounts receivables and Prudential takes them, what if one of those customers returns something to Delta? Delta doesn't have an accounts receivable anymore to credit. And guess what? Prudential's never getting that money. So this is the way they cover themselves. Okay? When the bank collects the receivables, it will remit to Delta the retained amount, which they've estimated has a value of $5,020. Okay? So Delta feels, we're probably going to get back about $5,020. They're going to collect everything. They also anticipate what they call a recourse obligation of $3,010. So Delta has estimated probably about $3,010 of those accounts receivables will never be collected. The bank charges a fee of 3% and requires that amount to be paid at the start of the factoring arrangement. So let's see what happens. Accounts receivable credited at Delta, $61,800. Cash debited, $53,766. Receivable from factor, $5,020. Recourse liability is credited, $3,010. Loss on the sale of receivables, $5,020. So $6,024. Let's take a look at this. So at the beginning, they're only giving them 90%, or $55,620. And if you're going, well, that's not the amount. I know. Why is it different? Because in addition, they take a fee up front of 3%, or $1,854. So subtract that from the $55,620. The actual cash, $53,766. The company feels that they will still, that Prudential will probably collect most of these, if not all of them. There will be very few sales returns. So they feel that they still may get from Prudential another $5,020. So the max they get might be almost $58,786. The recourse liability is a potential liability that Delta has because some of the customers may never pay their bill to Prudential. And because these were sold with recourse, Prudential could come back at them and collect that money. So they've got to create a liability just in case. And they've determined that to be about $3,010 based on past experience. And then we credit accounts receivable. So this recourse liability is created when receivables are sold with recourse. Without recourse, there is no recourse liability. Okay, so take a read through that, make sure you understand it, and ask any questions. Exercise 728. The petty cash fund of Harvey's Automotive contained the following items at the end of September 1. Currency and coins are $52. There's some receipts in there. $20 delivery charge, printer paper 13, paper clips and rubber bands 9, an IOU from an employee, $17, and postage 32. So it totaled $143. The petty cash fund was established at the beginning of September with a transfer of $143 from cash to the petty cash account. So it looks like it's pretty much in line if I'm reading this correctly. So to replenish the petty cash, they'll debit delivery expense, $20. Remember, as the money is being taken out of petty cash, we do not make journal entries for those charges. We wait until we replenish. Somebody takes all the receipts in from petty cash and says, I need more cash for the petty cash drawer. Okay, now let's debit delivery expense for that 20. Let's debit the office supplies for the printer, paper, and the paper clips of 22. Let's debit receivable from employee 17, and let's debit postage expense for $32. And we'll credit cash for 91. The total 143 that should be in there minus the 52 that are still there. We only need $91 then to replenish petty cash. As I said, the day, if you and from your reading, the day petty cash is established, we debit petty cash, credit cash for the fixed amount. We do not change the petty cash fund account itself for any other journal entries unless we increase the fixed amount or decrease it. It is on replenishment that we debit the accounts that would be affected when we gave money out. So we're replenishing it for the $91. Exercise 729. Hanson's Company's general ledger showed a checking account balance of $24,400 at the end of May. The May 31st cash receipts of $31,400 included in the general ledger account were placed in the night deposit box and were processed by the bank on June 1. The bank statement dated May 31st showed there were bank service charges of $44, and all the checks written by the company had been processed by the bank by May 31st and were listed on the bank statement except for checks totaling $24.30. So this is a real simple, straightforward bank reconciliation. Remember, a bank reconciliation is necessary because a checking account records are being tracked by two distinct, independent entities. The company tracks their records in the general ledger T account. They debit cash, credit cash for every transaction they have through their checking account. So they keep a running record in their T account. The bank also keeps track of cash transactions through their own processing system, and they report that information on a bank statement. If all is well in the world, the bank's balance at the end of the month and the company's balance at the end of the month should equal. And sometimes they don't. And why don't they? Well, sometimes there's the bank balance is what we would start with in a bank reconciliation. And here we're looking for items that are not added or subtracted to our bank balance. So these are items that were in the company's checkbook but are not processed through the bank yet. Things like deposits outstanding. That night deposit was processed June 1. That will not be on the May 31st bank statement, but it was a deposit in our company's records on May 31st. That should have been on the bank statement. Checks that were written out of our checkbook but are not cashed yet at the bank. They're missing. They're called outstanding checks. And there's a total of 2430 of them. Any errors on the bank side would be added or subtracted to find a correct balance that should have been on the bank statement for that month. We do the same thing with our checkbook, but now we're looking for items that are on the bank statement that we don't have recorded in our checkbook yet, in our general ledger. Things like collections by the bank. If the bank collects money on our behalf and they don't report it to us and nobody does, we won't know about it until we get our bank statement. EFT payments and receipts are another common item that may be not listed in our checkbook, but we'll catch them on the bank statement. Service charges. Normally, we don't see those until we get our bank statement. We must deduct those. NSF checks from customers. Checks that the customer sends us that have non-sufficient funds that were added as a deposit, but now we find out they should have never been added. We must subtract those. And then errors on our part. Maybe we made a mistake while adding or subtracting. We must correct that now in our checkbook. Once we find the missing items that are not on the bank statement and add and subtract them, and the missing items that are not in our checkbook and add and subtract them, the corrected balance of each should equal. And that's the correct balance of our checking account. So, for May 31st, this company's book balance was $24,400. It's the checking account balance. There were deposits outstanding of $31.40. There was a service charge of $44 never recorded. There are outstanding checks of $24.30. So the correct balance, really, to do a classic bank reconciliation, you should have the ending bank statement balance as well. It's missing here. But the correct balance that should be recorded is $24,356. And really, you should have been given the $23,646. Okay, so take a good look at the bank reconciliation problems at the end of the chapter, more in the appendix, but I am making you responsible for that. You want to make sure you know how to do a bank rec. So there's a lot of information in this chapter. We first looked at cash, then accounts receivables, estimating for uncollectible accounts. Then we looked at notes receivables and recording journal entries related to those. What happens when we sell accounts receivables, journal entries related to those, or we take a loan and use the receivables as collateral, petty cash, and now bank reconciliations. Lots of stuff. Like I said, post any questions you may have.